Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project. I'm your host, Duc Ong with Tri-City Equity Group. Today we have Arn Cenedella on the show. Arn is a real estate broker and investor with over 43 years experience in the real estate industry. Arn started as a residential broker in 1978 and built a thriving Silicon Valley's residential brokerage business while accumulating a sizable portfolio of single-family rentals, both in the Bay Area and across the U.S. Arn founded Spark Investment Group in 2020 as he transitioned his single-family rental portfolio into multifamily. Arn currently has a portfolio of over 1,300 units as a limited partner and 433 units as a general partner. Arn, welcome to the show.
Hi, Duke. Thanks for having me on. Looking forward to having a nice chat with you.
So what is your why for building passive income?
Well, my why for building passive income is to have the time freedom to kind of live the life that I've wanted, that I want. And so I've been fortunate enough through my brokerage activities, which then led to my investment activities, to create an income sufficient for me to enjoy kind of a nice life-work balance. And many of my friends work very hard in their W-2 jobs, 60, 70 hours a week. And I'd like to help them kind of develop other income streams so they can maybe have a little more time and freedom to pursue their passions, friends, family, community, whatever is of interest to them.
Gotcha. And are you active in the brokerage business still?
I do a little bit of brokerage, but now that I'm primarily focused on multifamily, I'm pretty much acting as a principal, either generally now as a general partner, though I do co-GP with other operators who we have similar aligned interests with. So brokerage business is very minimal. I'm pretty much a full-time investor.
I see. So what markets are you invested in and why are you in them?
Good question. So I'm located in Greenville, South Carolina, which is kind of midway between Charlotte and Atlanta, up in the northwest part of the state. So I really like the Carolinas, particularly the Southeast as a whole. So all of my multifamily investments are in the Southeast. And the other region of the country I particularly like is the Mountain West. So I have investments in Boise and also Colorado Springs. So for me, kind of the Mountain West and the Southeast with particular focus on the Carolinas is where I do most of my work.
I see. So what drove you to start looking into those markets in the first place?
Well, basically, I was born and raised on the San Francisco Peninsula in what became Silicon Valley. And about 7 years ago, we moved to Greenville, South Carolina to kind of start a new life adventure. So I think my presence in the Carolinas is a big part of my focus in the Southeast. But in general, you have population growth, you have job growth, fairly low tax rates, fairly landlord-friendly regulations in terms of tenant-landlord issues. Businesses are moving in and population's falling. So I think those all combine to make an excellent market to invest in. The other thing I would say, we all know real estate's kind of local. Location. And I think by being in Greenville, South Carolina, in the Carolinas, having firsthand local knowledge of some of these particular submarkets proves to be an advantage in looking at potential acquisitions and also the operating of the ones we do buy.
Yeah, real estate is definitely hyper local. So
you have to know the market, and there's a lot of great data out there, CoStar and Berkadia and all that data is useful. but we also know neighborhoods and submarkets change block by block. And so having an intimate knowledge of the local markets you invest in, I think is critical to get kind of a little bit of a competitive advantage in a competitive space like multifamily is now. To make good acquisitions, you need to, use whatever advantage you have. And in my case, one of the most important one is local knowledge here in the Carolinas.
Yeah, that makes a lot of sense. So how has your experience in residential brokerage helped you with your investing career?
Yeah, good question. So let me say most of the multifamily properties I'm doing are garden style apartments, 1, 2, 3-story buildings. So for one, the type of construction is very similar to single family property. So over my 40-year career of owning a bunch of rentals, dealing with roofs and hot water heaters and HVAC systems, dealing with tenants, finding tenants, getting repairs done, the transition from a single family to kind of a garden style apartment building is fairly smooth because the major systems in both types of property are very similar. It would be vastly different if I was investing in a 50-story high-rise building. That I don't have any firsthand experience with. So I would say just learning how to deal with tenants, get properties rented, working with contractors, understanding how the buildings work. I think that's helped me make a relatively smooth transition from single family to multifamily.
So I'm also a real estate agent along with some of our listeners. So what advice do you have for those agents who are also looking to invest in real estate?
Well, I would say, here's what I would say. I went to work for my dad in 1978, and he taught me not only the brokerage business, but he also taught me the investment business. And he was an old school single family home investor. So what I would say to your listeners who are real estate agents, I would ask them to kind of consider the brokerage business can generate good income. It can create cash flow. It can create capital to invest. I would submit the way to kind of financial freedom, though, is probably through real estate investment. So I think if you can use the income that you develop through your brokerage business, get that invested on kind of some long-term plan, that would be a key to kind of achieve financial freedom. More specifically, you're in the market as a broker, you're out there every day, you're meeting with buyers and sellers, you're meeting with tenants, and you develop a network of people who, one, probably want to invest in projects that you find. So I think it's an easy evolution to have a client who's been a buyer or seller with you for several years, easy transition to have them be one of your partners on your investment side. So I would nourish those relationships you make through your brokerage business to further kind of your investment business. And you just get to know the contractors, the property managers, the lenders. And so we're kind of doing it every day, right? Where for a W-2 employee working for a big corporation, they don't have the freedom to kind of get out there in the community, get in the streets and network with people at property. So I think being a real estate broker allows a little bit of freedom and greater network opportunities.
Yeah, I agree. There's definitely some excellent synergies there.
Yes, because as a broker, the clients that work with you, they trust you, right? You develop a relationship of trust and caring and also friendship, and maybe you enjoy each other's company. And so when they're thinking about, well, who do I want to invest $50,000 with or $75,000 with, investing it with somebody that you know, like and trust would be the expression, somebody that they know who's taken good care of them in the past and who you've demonstrated your real estate expertise to, I just think it's a nice way to go about doing the business. And I would say the people who are busy in high income W-2 jobs, I think they understand real estate is a good investment, but they may just not want to take the time to mess with dealing with tenants and do everything that's necessary to operate the property. So folks like us who offer passive investments, I think provide a good service, allow people to get into real estate, benefit from real estate investment without having some of the hassles. And being in the business, we know there can be hassles.
Oh, yeah, definitely. So let's talk about the last deal that you did. Was it in the Carolinas? What's the unit count?
Yes. So the last deal I did, I actually closed December 28th. We're now recording what's today, January 8th. So say about 2 weeks ago, 10 days ago, it was 30 unit Class B property in Greenville, South Carolina, kind of a upper middle income single family residential neighborhood. And there happens to be this 30 unit townhouse complex plopped in the middle of it. So median household income in the neighborhood's about $85,000. These are nice 2-bedroom, 1.5 bath townhouse units. And we ended up, it was about a $4 million acquisition price, $133 a door. And we raised about $1.6 million, had 27 investors, and excited to take it over. And we're right in the process of executing our first month of operation.
Nice. Congratulations.
Thank you. Yeah.
Yeah. So what is it like buying in this super low cap rate, highly competitive market, especially in the Carolinas?
Yeah, it's and I can tell you the deal prior to that, we entered into contract March 2021. So the deal that closed in December, we entered into contract, say, about October 2021. And as you well know, prices have continued to go up for assets over that time in that 6-7 month period. So the December purchase was at about a 4.5 entry cap, where the earlier spring of 2021 acquisition was at about a 5.2 entry cap. So in a period of about 8 months, the cap rates dropped about 0.5. The second property's in a little bit better location. It's a good high B. The other one was kind of a C plus B minus. And so there might be some factors there. So clearly in low cap rate environments, it's hard to find properties that throw off a really high cash on cash return out of the gate. So what I try to look for are areas and or properties where, one, with the properties, we can operate them a little better, cut down on vacancy, cut down on some expenses, get the rents up. In the earlier 2021 deal, the current owner didn't provide washer dryers, stack washer dryers for the units. We've put them in now. Every unit we renovate, the hookups were already there. So it was built that way, but the owner didn't supply it. And we got an easy $100 a month bump from putting in a $1,200 stack washer dryer. So one, look for properties that you can increase the income by operation. And then I think the other thing, I'm kind of an old school long-term guy, meaning buy real estate, let time and appreciation and inflation win the day for you. So I think if you buy in good growth areas, you're also going to benefit from that. So cash flow may not be huge year 1, year 2, while you kind of get control of the building, the property, make it run better. But when you do, you get some value there. And then if you're in the right area, the long-term dynamics are good. And 3-4 years later, you now have a really nicely performing property, which is increased in value. And you can either hold it and continue to operate it, or take advantage of the increased market value and move on to a different project or a bigger property. So competitive, I think expectation levels have to be set. And my own sense is multifamily has had a phenomenal run of 7-8 years. My own sense is multifamily is still going to do very well. I just don't know that we're going to quite get the same bump we did the last 5 to 7 and the next 5 to 7. So I think investors have to temper expectations a little bit, and operators have to be realistic with that. And so I think, in my experience in dealing with people, if you set proper expectations and you exceed them, they're happy. So that's what we try to do.
Gotcha.
Yeah.
So where do you think multifamily is heading this year and in the near future?
I think multifamily is still going to be strong. I do think at some point interest rates will increase a little bit. And even though there's not a direct correlation between cap rates and interest rates, there is some correlation there. So multifamily is still going to be strong. There's affordability issues in most metropolitan areas in the United States. So affordability is always going to be an issue. And of course, apartments are the most affordable option for living for most people. Number two, it's clear we're lacking, 10 million housing units in the United States. So that demand is going to keep the market strong. So I expect the multifamily market to do well. We may hit a little turbulence. I would expect maybe 18, 24 months out. But if you go into the deal properly capitalized, using good leverage, and have some kind of long-term perspective, the long-term trend's definitely still up. So I'm still very bullish on it, and I'm looking to buy more.
And what's your exit strategy on your deals currently?
So I have not yet gone full cycle on any. I'm fairly new in the multifamily space. On the first one, we got 7-year agency debt, and I think that's going to be probably a 6-7 year hold. And I think at that point, we may exit by sale, or perhaps we execute a refinance and continue to hold the property longer. On the most recent acquisition, we got a loan from credit union, 2 years interest only, and then it moves to 25-year amortization, 5-year note. On that one, we expect after 2 years, we'll probably refinance that one into longer-term agency debt. So most of our deals tend to be targeted more 5, 6, 7 years with some potential to extend the hold. But of course, as you know, sponsors, operators have to adjust to the market, right? And if somebody comes by and wants to give me, X million for a property, I'll have to consider that and decide what's best for the investors. But I think right now, both these would be considered longer term holds. They're not heavy lift, value add, quick turnaround deals.
I see. So when you underwrite these deals, what terminal cap rates are you projecting?
Typically, I kind of go with the industry standard. On the first deal, we did an exit cap. We came in at 5.2. We used a 6 exit cap. On the most recent deal, we were coming in at about 4.5 entry, and we used a 5.3 exit cap. So we generally, industry standards kind of a 1/10 per year per hold, your estimated hold time. So we try to do at least that, and maybe we add a 1/10 or another 2/10 just to try to be extra conservative. So we kind of follow industry standards with 1/10% addition to the cap rate every year of hold.
I see. And what kind of rent growth numbers are you assuming? I know that Carolinas have been booming, right? So
yeah, so that's interesting, because on both of these properties, we perceived that the current rents were, let's say on average, 100, 150 below market. So in our kind of projections, the first year or two, we're kind of projecting 7, 8, 9% increases, which isn't so much rent growth above market. It's more about bringing the current rents to market. And then after that, we back it back down to about 4% a year. So typically we kind of plan for a significant jump year 1 and 2. For example, on the earlier deal in Greenville, South Carolina, Carolina Commons, average rent was about $600 a month on the units. We projected $850 a month in year 4. Well, we just rented a renovated unit at $850 a month. So in less than a year, we've already kind of hit our year 4 target projections for rent. But again, better to be conservative than overpromise. And I think most operators are seeing their rent projections have turned out to be a little bit conservative. And I think that's just kind of the current market. And at some point, it'll kind of level back out a little bit.
And what kind of equity multiples are you seeing on your deals?
For a 5-6 year hold, we're right around 2. It could be 1.93. It could be 2.05. But generally about 2 for each 5 or 6 year hold. Yes.
All right. So now let's transition to our fire round. What is the best book that you recommend other than Rich Dad, Poor Dad?
Oh, what's the best book I'd recommend? Well, I recently had a family tragedy, so I'm reading a book now about grieving the loss of someone you love. So right now, that's kind of in the forefront of me. So it's not a business book, but that's the one that I recommend for anybody who's lost somebody who's close to them. It's tough, but you just got to get through it and go on.
What is your superpower?
Good question. I would say my superpower is motivating people and putting together teams. So I'm not kind of an operator. I don't say I'm really detail oriented. I'm kind of more big picture, see the vision, bring the energy, find the appropriate people to make a complete synergistic team. So I think attracting the right people, motivating people to form some coherent, effective team is probably what I do best.
Okay. And what is the biggest lesson that you've learned over your career?
The biggest lesson I've learned, I would say, is to be authentic, be open. People can tell when you're being genuine. And I think that's the key, because that's the key to building relationships. And I would say building relationships is the key to success, right? The common expression, your net worth is your network. And so I think if you go about yourself in the world in a way with character and integrity, you attract similar type of individuals, and building those trusts and relationships is really what allows success to happen.
Yeah, I couldn't agree more. So for the busy working professional working towards financial freedom, what advice do you have?
I would say buy real estate. And I think, sometimes we get questions, well, would it be better for me to buy a couple single family homes or invest in a multifamily syndication? Where's the better rate of return? And I would say the answer isn't so much about the rate of return. The answer is about, do you want to be active or do you want to be passive, right? How much time do you have to devote to active real estate activities? The other part of it is you could be a great software architect, engineer, designer, but maybe not a very good real estate operator. So I think each person kind of has to figure out where they want to deploy their time, what's the best use of time. And that the answer to that question then I think will put somebody in either the active path or the passive. And of course, you can do both too. I think there's room to do both. But I believe in real estate. It's historically proven to be a key way to create wealth. So I would just encourage people to invest in real estate. Coming from Silicon Valley, many of my friends and clients, they're really invested in the stock market. And so I would say to them, consider kind of diversification. I'm not suggesting you sell everything, but take a certain percentage of your investment portfolio, get it into tangible assets like real estate, lock in this great long-term low rate debt. And you'll be happy you did 5-7 years from now.
Absolutely. Well, how can our audience get in touch with you?
Sure. So the name of my company is Spark Investment Group. So the website is investwithspark.com. And I'm on Facebook, LinkedIn. Email address is Arn, A-R-N, at investwithspark.com. Happy to talk to people, love talking real estate, and happy to help however I can.
All right. Thank you so much for being on the show.
Hey, thank you, Duc. Thank you so much.
If you're interested in investing with us, go to tricityequity.com to learn more. To connect with like-minded investors, join our Facebook group, Honolulu Multifamily, and more. If you found value in this podcast, please subscribe and give us a review on Apple Podcasts or Spotify. If you know anyone who might resonate with today's podcast, please share the episode with them. We're also super excited to share with everyone our upcoming conference, the Hawaii Millionaires Mindset Conference, The Blueprint. Come join top industry leaders for motivation, training, and lots of networking. This will be happening here in beautiful Ko'olina, Oahu, next year, July 21st to 24th, 2022. There's still some great specials happening now, so if you want the absolute best pricing, go to millionairesmindsetblueprint.com to find out more. See you next time.